Hello and welcome to our Retirement and Wealth Strategies webinar series. I'll be your host and moderator for the day. I am Nicholas Scarcella, Vice President of RWS. Today we'll be focusing on the economic and market overview with a presentation from one of our trusted partners, Advisors Capital Management. We have a fun structure for today's webinar to keep content interactive and lively. First, our presenter, Dr. Charles Lieberman, will present an overview on the economy and the financial markets. This will be about 40 minutes long. Then we'll introduce three of our RWS advisors to create a panel for Q&A based on prepared questions that we gathered from interviewing our clients, hearing their questions, their fears, and opportunities that they're wondering about. Good news, we will be done just in time to watch the Lions beat the Packers tonight. The Lions coordinated the Thursday night football around our webinar, 8:15 start time. So with that, let's get started. First, a brief overview introduction to RWS, then I'll hand the presentation over to Chuck. At Retirement Wealth Strategies, we are a fiercely independent wealth management firm. We're established in 1985, so over 35 years of experience. We do have 17 offices, with our home office in Farmington Hills, Michigan. As a company, there's about 32 financial advisors, and we do serve around 7,500 families across the country. Next, we'd like to share our core values at RWS. These are our commitments to our clients, which is education, trust, relationship, compassion, and competency. First, education, that's what we're doing here today, educating our clients, providing these webinars into the communities we serve. Trust, it goes without saying, trust is the cornerstone of what we do. Relationships, we pride ourselves on our relationships, the friendships we build with our clients, and also helping multiple generations in that family tree. Compassion, that's our patience and understanding to your evolving needs and circumstances. And finally, competency, the duty to be experienced and credentialed. Upcoming webinars, this is our 8th webinar as a company. We appreciate the viewership we've had. We have had strong growth in our viewership, and this supports one of our core values, which is education. Upcoming events, we do have next month, October, identity theft and fraud with Dr. Lichtenberg of Wayne State University will be our guest speaker. Housing market challenges and outlook in November. December, we'll have the month off for the holidays and year-end busyness. Revisiting in January, we'll have another market update and outlook, and popular choice in February of next year. So please continue providing the feedback. It really helps us create this content for you all. Housekeeping, and then the floor is Chuck's. So a little housekeeping here. If you're eating dinner, yelling at your dog, don't worry. It's a Zoom webinar. There is no audio from your standpoint. The presentation will be roughly 40 minutes. We appreciate your feedback. Please text all questions if you have Q&A throughout, and the webinar will be recorded if you want to listen to it again or share it with family or friends. So with that, a proper introduction to our presenter, Dr. Chuck Lieberman. Everything I'm about to share just means he's incredibly qualified, and we're all in for a treat. Dr. Charles Lieberman is the Chief Investment Officer and co-founder of Advisors Capital Management. He began his professional career as an academic at the University of Maryland and Northwestern University. After 5 years in academia, he joined the Federal Reserve Bank of New York as the head of its monetary analysis staff before coming to Wall Street. After years of experience in the financial services industry, Chuck co-founded the investment company Advisors Capital Management. Chuck frequently appears on Bloomberg and CNBC and is frequently quoted by Barron's and Wall Street Journal. Chuck earned his bachelor's in economics from MIT and his PhD in economics from the University of Pennsylvania. With that, welcome, Chuck.
Thanks very much, Nick, and good evening, everyone. I'm going to go through how we see the economy and what the Fed is trying to do and all of that. It's going to be a focus on what's driving markets, which is, of course, the key to all of this. Am I in control of the chart package?
You should be able to share your screen now, Chuck, if you could, for your slide deck.
Yep, I've got it up, and I can definitely do that. Let me know if you see it.
Yes, we're live.
Okay, good.
Okay,
Okay,
thank you.
so we're going to go through some of these slides. Actually, I think you're controlling the slides, not me. So I may just ask you to advance them one at a time. So the issue right now, without a doubt, is the rate of inflation. The Fed is very concerned that inflation has kicked up to an unacceptable degree, and they are committed to reducing it. The first slide gives you a taste of that. And again, I don't think I'm controlling the slides.
Chuck, it should be you should be live control now. Yeah, it looks like that's you.
You think it's me? Okay, let's see. You are screen sharing. Can you see the slides?
Yeah, we can see the slides. Try hitting what's that?
How's that?
Yep, that's you. Perfect.
Okay, great. Okay, so here's inflation. And you can see the big surge that took place. You can see that it peaked more than a year ago and has been coming down. That's the good news. The truth of the matter is that it's a bit of a temporary phenomenon, because what happened was we had the pandemic, and during the pandemic, lots of things became unavailable. Auto manufacturers couldn't get parts. Companies couldn't get computer chips. There were scarcities and bottlenecks all over the place. And we went from seeing new car prices go from a negotiated price of MSRP, let's say minus 5,000, to MSRP plus 5,000. Take it or leave it. And that also got reflected in used car prices, which also surged. So you can see why the big surge took place. Also, the economy was hiring like crazy. Employment was rising quickly. Unemployment was falling very rapidly. And in fact, it was very difficult to get workers. So we peaked. And the big surge that took place during scarcity has largely disappeared, because underneath the surface, as supplies increased, prices came down. But what happened to the cost of production? MSRP was rising. And so even though we went from MSRP plus 5,000 and we're working our way back, we're not there yet, but we're working our way back towards MSRP minus 5,000, that actually numerically causes deflation for autos. And so the inflation numbers are actually artificially depressed, even though they're still running hot. And once things get back to normal more fully, we'll get a much better sense of the underlying trend. And the underlying trend is just not that favorable. And the reason it's not that favorable is because of the labor market. So here you can see the unemployment rate. And I've given you a lot of history, more than 50 years of it, so you can really put the current numbers into some sort of perspective. And you can see that the unemployment rate today is historically low. And that's why it's very tough for firms to be able to hire workers. They can post job openings, they can offer bonuses to people to come join. But the fact of the matter is, there are relatively few people who are unemployed. And as a result, there's a lot of competition for them. And firms are finding that they've got to raise wage rates. We can also see this in other data related to the job market. So here's job openings. And some people would argue that we've seen a big decline in job openings. And so the Fed has kind of accomplished some of what they want, which is to make the labor market less hot. And job openings have come down. But they've come down from the peak. And as you can see from this graph, job openings are still very, very high historically. Now, if the job openings numbers continue to decline, then there's a much better shot at getting wage inflation to behave better. But we're not quite there yet. Another way to see it is in quits. So ask yourself the question, if you thought that it was going to be tough for you to find another job, would you quit your existing job because you're unhappy or you think you can make more money? Probably not. But as long as you think that the job market is pretty strong and you can find another job relatively easily, then you'd be far more inclined to quit. And we saw a lot of that post-pandemic. Hiring was very strong. Companies were forced to pay premiums. And of course, when you pay a premium for a new hire, you probably have to increase the wage rates of your existing employees. And put that together, and this is what you get. You get an acceleration in wages. So worker earnings have been rising more quickly. And this is critical because 70% of the cost of producing GDP is accounted for by labor costs. To give you a sense of that, take an automobile and think about all of the steel, the aluminum, the rubber, the glass, the copper wiring. Put together all of the value of all of those commodities that are embedded in a car, and there is more healthcare expense in the workers in that car than there is all the commodities put together. So that gives you a flavor of how important labor costs are. So when labor costs are rising more quickly, it's very difficult, if not impossible, for firms not to have to raise prices to take into account their higher costs of production, higher costs of providing goods and services. And the flip side is also true. If wage rates were to decelerate, if we saw slower wage inflation, then we would be confident that overall inflation would also start to come down, would slow down. So the bottom line is that the labor market is really critical to the Fed and to the economy more generally. And that's why we continue to follow the labor market data very, very closely. And so far, we have seen some movement in the right direction, but we're very far from where we need to be, given that the unemployment rate is so low. The labor market is very tight, no matter how you slice it. And that's why the Fed is so fixated on the labor market. Okay, let's look at some other data that is worth talking about. So here's a number that's a great example of how misleading the media can be. One of the stories that you've probably seen recently is that the consumer has taken on a lot of debt, and the total amount of credit card debt has broken above $1 trillion, a huge number. And some people use that to argue that the consumer is getting in bad shape, that they're carrying too much debt, and that the consumer's ability to spend is declining. The only problem with that story is it's not true. Here you can put the consumer's debt into some sort of perspective. This was total debt, and it's accurate. The data is correct. This puts the debt relative to GDP. And as you can see, the consumer has been paying down debt relative to GDP, relative to income, for quite a while. Consumer finances are actually in very, very good shape. And so the consumer has a lot of capacity to spend if they're so inclined. One of the interesting stories here is the behavior of the mortgage market and the housing market in particular. So when I think about the U.S. housing market, it is without a doubt the single most interest rate sensitive part of the economy. So when mortgage rates surged last year, we got the kind of response that textbooks say we would, namely that housing activity would weaken. So here are housing starts. This is new construction. And you can see that housing dropped from about 1.7 million at an annual rate to about 1.25 million at an annual rate. That's a big drop and clearly contributed to some slowing of economic growth. But then something strange happened in 2023. Even though mortgage rates rose some more, and you can see that in the graph, housing construction stopped falling. For 2023, it looks like housing is going to be flat to up slightly. And that is really not textbook. And of course, the question then is why? And the answer lies in several years of history. So go back to 2005, 2006, this period right here, when housing was absolutely booming. At the peak, we were running starts in excess of 2 million units at an annual rate. So housing was very, very strong. It wasn't right. We did not have 2 million new households per year. In the US, the number of households is growing ballpark 1.4 million, and then we demolish about 100,000 units. So that means we need 1.5 million. And then there has been some growth in second homes. That's worth at least another 100,000. So now we're up to 1.6 million. So what do you do with the extra units when you're producing over 2 million units? What was happening was there was a tremendous amount of speculation in the housing market. Housing prices were rising, and a lot of people started to buy homes not to live in them. They bought them to flip them, to pay one price and sell them a little while later to someone else at a higher price. And that game went on for a while, and it encouraged builders to build a lot of homes because they could sell them. The speculators were buying a lot of homes. But that game hit a wall. When you run out of buyers and you're a speculator, you've got a huge problem, because until you sell that house, it entails a lot of costs and no revenue. You've got to pay someone to mow the lawn. You've got to pay insurance. You've got to pay mortgage costs, property taxes, maintenance, utilities. It's expensive to own a home. And if the house is sitting there on the market and you haven't sold it, you're losing money every single day that you own it. And so the people who bought all of these homes had no choice but to try to sell them. And the only way to succeed in selling them was to underprice your competition. Cut your price, sell it. Even if you take a loss, it's better than losing money every single month. And so housing prices started to come down, and that was a signal to everyone this game was over. With housing prices coming down, builders were stuck with inventory, and they had to cut price, and they had to stop building. And that was really the only way to fix the problem. We overbuilt by hundreds of thousands, maybe even 1 million units in excess of underlying demand. And there was nothing the Fed could do to fix this problem, because lowering interest rates only reduced one of the costs of owning a home, the mortgage cost, if you refinanced. But it reduced none of the other expenses. And so there was no way to fix this problem except to reduce construction and give the economy time to grow more households to absorb all of those vacant homes. And we did that in spades. Housing construction went from over 2 million units to around 500,000 units. So a massive decline in construction of more than 75%. Massive. But then we kept it there. And notice how low housing activity was, even though it was recovering and the home construction market recovered and builders started to build again and all of that. But the level of construction was well below the underlying growth in households. And so we created a shortage. And that's where we are today. That's why you have bidding wars for houses all over the place. When a house comes up on the market, if you're interested in it, you have to put in a bid fairly quickly, because if you don't, it'll come off the market very rapidly if it's priced anywhere near right. So we're seeing this massive shortage in the housing market, and that's providing a lot of support to housing construction. Now, you'll also hear about the very low level of sales, that home sales are down very sharply, and that, of course, is blamed on mortgages. When interest rates fell, and boy, did they, when we were back here, mortgage rates got down into the threes. You could get a 30-year mortgage at 3 or 3.5%. And of course, anyone who's got a mortgage like that just would be turned off very badly about the idea of buying a bigger home and now have to give up their 3% mortgage to take out a 7 or a 7.5% mortgage. So a lot of people are either unhappily or happily locked into their existing home with their existing mortgage. So resales are pretty scarce. There isn't a lot of inventory coming on the market. And in truth, that's largely irrelevant, because imagine for a moment that somebody who owns a home decides they are going to move and they put their house on the market and they sell it. Where are they going? They're likely going to buy another house or move into an apartment. But either way, they put one housing unit on the market and they're taking another housing unit off the market. So their net demand for housing is essentially zero. The incremental demand for housing comes from the incremental number of new households. And that's a pretty steady, pretty solid ballpark of, call it 1.5 million. And we're still running at a low level relative to that. So with current housing starts, we're not eating into the shortage of housing at all. And therefore, the housing industry has much more room for recovery. And therefore, also the rise in interest rates is unlikely to precipitate a recession in housing. And in fact, that's actually a common theme through the entire economy. When I think about how interest rates are going to hurt the economy and how they could cause a recession, it's really kind of hard to come up with the sectors of the economy that are likely to be hurt enough to push the economy into recession. It clearly is not the case with housing. And it can't be the case with households, consumer spending, which is by far the biggest part of the economy, because we still have strong job growth. And when you have a lot of people being hired and you have wage rates going up, then consumers have more income, more firepower to finance spending. And so the economy is actually continuing to do quite a bit better than people anticipated. Go back a year and a half or two, and there were widespread forecasts of a recession sometime soon. And soon kept on getting pushed further and further out. And here we are now near the end of 2023, And I'll tell you that I don't yet have a recession on my radar screen. I don't think I can put together a package of weakness to cause a recession. That's not to say there won't ever be another recession. Of course, there will be. But we don't yet have conditions in place now or visibly in the near future to cause a recession. And yet the Fed is hoping that employment growth is going to slow down, so there'll be a little more slack in the labor market, and wage inflation will moderate. But I'm sure, as you all know, because you live in the Detroit area, you know perfectly well that labor is now taking advantage of the tight labor market and pushing for large wage increases. The auto companies are dealing with strikes, and they're not the only ones. There have been more strikes across the country in different industries, and more wage negotiations that have been, shall we say, rather successful from the perspective of labor. So the airlines negotiated a new wage package for their pilots. About 40% in 4 years was typical. That's 10% a year. There's no way to avoid upward pressure on airfares when you have that kind of an increase in wage rates for pilots. And of course, it sends a message to all of the luggage handlers, the stewards, the flight attendants. Everyone else sees that, and they also push for their own wage increases. And now we see that happening in spades in the auto sector. We saw it with UPS and FedEx and many other parts of the economy. And that's the psychology, that's the situation that the Fed needs to contain. And it's not going to be easy. The easy part has already been done, but there's more to do. So let's move on. Here's an amusing statistic for you to give you an idea of how out of whack the housing market is. In January of 23, 1.04 million homes for sale across the country. Big drop compared to prior years. 1.45 million realtors. So we had less than one house on the market for sale per realtor. Tough making a living as a realtor in that kind of environment. Okay, what else are we dealing with? Well, another big issue that we're dealing with, of course, is with the banks. And what happened with Silicon Valley Bank, which then created a mini banking, I hesitate to call it a crisis. I think that's overstating it a bit, but it certainly created some disruption to the banking sector. So what happened was that Silicon Valley Bank took in a lot of deposits and then invested those funds in the safest asset they could buy, which was U.S. government bonds. The problem was they didn't buy short-term government bonds. They bought long-term government bonds. And when interest rates rose, long-term government bonds fell sharply in price. Had they bought short-term bonds, the price effects would have been small, and they could have waited for those bonds to mature, get their money back, and reinvested it at a higher interest rate. But that's not what they did. They actually bought these long-term bonds. And when interest rates rose, the bonds fell so much in value that outsiders like me could do the calculations, and we calculated that in Silicon Valley's case, their capital was completely down to zero, completely lost. They lost enough money in their bonds to wipe out their capital. And when depositors saw that, they pulled deposits out of the bank. The bank then had to start selling assets, which is those bonds, at big losses. And that they couldn't sustain that. And that caused the bank to go bankrupt. And there were a couple of other banks that were in similar dire shape. And it scared depositors across the country. Well, the government stepped in, they guaranteed the deposits of those banks. Everyone calmed down, they got a second breath, they calmed down, and the realization was this was an isolated case. The people who ran Silicon Valley Bank were clearly incompetent in terms of risk management. And fortunately, we haven't seen a repeat of this anywhere else in the country. So the banking sector is okay, and they're lending, and it's back towards normal. Not quite, because bankers were traumatized, and so they're being much more cautious about lending. So it's a little tougher to get a loan today. You might have to pay a bit more in interest. You certainly have to provide better financials to be willing to, for the bank to be willing to give you a loan. And there was some concern that deposits were flowing out of the banks, and that was true for the large banks. But for the smaller banks, they're recovering. The truth of the matter is, the large banks don't need all of the deposits that they have, because the Fed and the regulators are beating them over the head to be careful about their lending activity. So they're very cautious about lending. And that in and of itself helps the Fed in slowing the growth of the economy. That's actually useful to the Fed. But the smaller banks are recovering. Deposits have rebounded, and they're also a bit more cautious, but the whole situation is getting back a lot closer to normal. The market expects the Fed to hike rates one more time. The Fed has been slowing down the pace of rate hikes. Last year, they did 4 75 basis point rate hikes in 4 successive meetings. They were trying to get rates up as fast as they could without disrupting the economy. But the higher rates are, incrementally, the less they have to do. And so they went from 4 75 hikes in a row to a 50, then a 25, another 25, then they skipped a meeting, another 25, and then they skipped the last meeting. So the Fed is slowing down the pace at which they're increasing interest rates. For one thing, they want to see how much the rise in interest rates so far, how much that is slowing down the economy. What have they accomplished so far? And as I showed you earlier, the pace of hiring is slowing, has slowed, but the unemployment rate is still very low. So they know they aren't where they need to be quite yet, but they know they're a lot closer. And the proof of the pudding, or the acid test, is how much will inflation come down. The whole objective here is to bring inflation back towards 2%. And we're running closer to 4%. So they know they've got further to go. They tell us that at every meeting, every time they do a press conference, every time they do a public speech, every time they communicate to the public, they keep on saying, we're not quite there yet. We need to bring inflation down more. We may have to increase interest rates more. So they've been very clear that the situation is not yet where they want it to be. And the market has finally gotten the message, and that's why the bond market has sold off so much. And the market still expects at least one more move, probably this year. And then the market and the Fed are both in wait and see mode to see what happens to the data, what the data tells us about how much inflation has come down, how much growth has slowed. It's all to be determined. It's all wait and see. We're all data dependent. And that brings us to an interesting question about the market, the stock market itself. How expensive or cheap is it? And I won't force you to look at the entire table, but I will show you a little bit to give you a sense of it. So look back at the 2000 column, March 24 of 2000. Looking back with the full benefit of hindsight, we know the market was very expensive back then. And if you look at the data, that shows it very clearly too. The price earnings multiple for the S&P 500 was around 25. Historically, that's very high. The yield on the S&P was 1.4%. The yield on the Treasury was 6.2. So if you're an investor trying to decide, should I buy a 10-year Treasury or should I buy the stock market, the S&P 500, and my horizon is, let's say, 10 years, I've got to have the belief that the stock market is going to grow by at least 4.8% on average per year for stocks to be attractive relative to treasuries. And that's a decent size hurdle. Now let's look at where we are today. The S&P is much higher, around 4,500. It's essentially tripled. But the PE ratio is down considerably compared to 2000. It's less than 19. And keep in mind that there are 7 stocks, Netflix, Google, Facebook, Amazon, Microsoft. Those companies trade with PE multiples of around 30. Apple's another one. And that's in these averages. And those 7 companies account for approximately 25% of the entire S&P. Take those 7 companies out, and the S&P multiple is around 15. It's actually quite reasonable. And even looking back at the last 20-something years, you can see at a PE multiple of 15, that's very reasonable. And then look at the dividend yield. It's about 1.6% for the S&P and about today it's about 4.5 for the Treasury. Call it 4.6. Well, at 4.6, to justify buying a stock, you've got to expect at least 3% growth per year. That's very doable. And so stock prices are no longer expensive. They're quite reasonable. And a lot depends on what happens with monetary policy. If the Fed keeps on raising interest rates, that's going to be a major headwind for the stock market. But if at some point the economy really does slow down a bit more and inflation moderates some more, then interest rates might come down a little, in which case I'd expect the stock market to take off. So that gives you the broad view of how we see the economy and the markets from, say, 60,000 feet. And let's address some questions.
Thank you, Chuck. That's my cue. Excellent overview, very informative, and love your delivery. So with that, let's introduce our few panelists here. So first up, we have Alex Potter, one of the panelists. We have Cheryl McGowan. Vote. And Todd Arner joining us as well. All right, welcome.
All right. Awesome. Who's gonna
Alex,
kick it off?
hello?
You want me to kick it off?
Yeah, please, Alex. You're live.
Awesome. All right, sounds good. Dr. Lieberman, thank you so much for hanging out with us tonight. So my question is, can you give us some advice on how to think long-term when it comes to investing, and what has helped you stay positive during times that are very difficult in the stock market?
That's a great and an important question. So one of the most important things to understand when you own a stock is that you're a partner with other people in ownership of that company. Your stock shares are not lottery tickets. Yeah, they could go up a lot in value, but unless the company goes bankrupt, your lottery ticket is not going to go to zero. And the value of your ticket reflects the profitability of the company. The company makes a lot more money. Guess what? That ticket is going to be worth a lot more money. So now put that in the context of the economy, which goes up and down. You have strong growth. Sometimes you have recessions. And when those things happen, profits move even more. So when the economy is doing well, profits go up very sharply. And when the economy goes into recession, profits fall sharply. And the stock market, for the most part, tends to follow the same pattern. To believe that your ticket, your lottery ticket, your stock share is going to be worth more, all you need is time and the belief that the economy will recover. And we've got a couple of 100 years of proof that that happens every single time. And oh, by the way, if the economy doesn't recover, it doesn't matter where you're going to hide, you're going to be in trouble no matter what. So you have to take a positive view to stocks long term. And if the stock market goes down, okay, you missed the opportunity to sell out when the stock was higher. But the worst thing you can do is sell out when the stock is lower. One of the lines that people use in the stock market all the time is buy low, sell high. Most investors do exactly the opposite. You know, when stock prices go down, they get scared and they bail out. And that is effectively selling low. And when do they get confidence to buy in? Well, the stock market goes up. And they feel like they should jump on board as well. But they're no longer buying at low prices, they're paying higher prices. And selling low and buying high is a way to guarantee that you do very poorly. So it's really helpful to have that longer term perspective, understand that you're buying a part of the economy, and over the long run, the economy is going to do fine, and stocks are the place to be, bar none.
Chuck, thanks for your insight. We appreciate you being here with us today. You know, we're here in Michigan, of course, the heart of the auto industry. And right now, the UAW strike against the big three is entering its third week, affecting 38 facilities across 20 states. Just kind of curious about how you think that this strike, if it turns out to be prolonged, is going to have an overall effect on our economy.
Well, it's clearly going to hurt growth. And in that sense, it's oddly enough beneficial to the Fed in trying to slow down the economy. But of course, you have to believe it's going to be temporary. Sooner or later, the unions and the auto companies are going to get together and they're going to work out a deal, and the workers will come back to work. And when that happens, what else is going to happen? You're going to see a surge in production to try to refill the pipeline with vehicles that are being depleted right now. The auto industry came into this with a low level of inventories. They still haven't recovered from the loss of production during the pandemic. They started to rebuild inventories. They started to supply cars to meet demand, but they're not back. They weren't back to normal right before the strike. Inventories levels were still at least 1 million units too low. Auto sales levels were still below where they were prior to the pandemic. And now we have the strike. And so the shortage in the shortage of cars, of vehicles available to consumers, is going to worsen over the length of the strike, however long it takes. And when the strike ends, you're going to then see a big pickup in activity, which will be somewhat temporary. We're going to go from a lower level of production to a higher level of production. So we're going to get a big one-time lift, but that's going to be a very positive tailwind for the economy, if only for a brief period of time.
Excellent. Thanks so much. One question that I get from a lot of our young professionals who are struggling with student debt as well as saving for retirement. And I'm wondering if you have any words of wisdom for those folks.
Well, those are two different ends of the age spectrum. For young people with student debt, obviously, that's a bit of a burden. Hopefully, you got a good education, and hopefully you got a good job, which will give you the capacity to pay off that debt. But the other thing to think about, which is crucial, is to start saving for retirement early. If you save early, if you start saving for retirement early, you have many years of compounding working on your behalf to build up a meaningful nest egg so that when you do retire, you've got enough assets to really supply you with the income that you're giving up when you retire. And when I first started to work, my first job as an assistant professor at the University of Maryland, I was putting some money into TIAA-CREF, and it was a small amount of money. This was a long time ago, and I was very well paid, but I was only making $14,500 a year, to give you an idea of how much inflation has changed perspectives. And I only had a few $1,000s in that retirement account. But I also had the benefit of a lot of years of compounding. And so it became a significant amount of money by the time I could retire. That's a different choice, a different issue. My kids joke that they're going to have to drag me out of the office someday because I have no plans of retiring anytime soon. I'm having too much fun. But that's how you build up a nest egg. And there's an old expression, it's not timing the market, it's time in the market. The longer you can invest, the longer you have compounding working on your behalf. Yes, there will be downdrafts, but then there will be recoveries. And so putting money away for retirement is hugely, hugely beneficial if you start early. Even if it's not a lot of money today, it'll be a lot of money by the time you're ready to retire.
Thank you.
All right. So another question I have is the advancements in AI technology. Do you really think it's going to be something that's going to really increase productivity for businesses and individuals, and that can you see that become a catalyst for continued growth in different sectors of the market? Do you see that to be an actual real thing, or is it a fad?
No, I think it's a real thing. But understand that it's not going to be like going from 0 to 60 in a heartbeat. It's a gradual process. And we've seen innovations help the economy out with productivity over many, many different products, many innovations over decades, if not centuries. More than 100 years ago, 150 years ago, the steam engine came in and revolutionized travel. Electricity came in and revolutionized how we live. The internet came in And it took a while for us to figure out how to really take advantage of that means of communication. And it's clear that AI is going to be a very significant contributor to economic growth. You know, when you call up your bank and you want to do something, check out your credit balance, or you want to wire money from your bank account somewhere. In most cases, you're talking to a machine, at least at first. And AI has enabled those computers to basically listen to your request, and in some cases go all the way through to processing the transaction without the intervention of a human being. Now, some are more complicated, and so they got to get a person involved to handle it. But all of this stuff is getting better and better over time. We're using AI at our firm, for example, to make presentations. You know, some of the presentation that you saw tonight was put together by AI. And
I thought you did all that. I thought that was your presentation. No,
I did none of it in terms of putting it together. The people who put it together knew what I wanted to say, and they put it together for me. But they used AI to put some of those slides together, and it saved them time. And that sort of thing is going to become more pervasive in the economy. There are some areas where we know AI is going to be huge. Take medical diagnostics. Right? When you have an issue of any kind, you go in to see a doctor. You're relying on the doctor's knowledge and experience to identify what the issue is. AI has the capacity to do that very, very quickly. And then hopefully AI doesn't make a decision about how to treat you. Maybe the doctor does, but the doctor now has a head start in trying to figure it out, because the AI has accomplished a lot of the work, and more accurately than experienced doctors. So there's an example of one more way that AI will help us all. And it's hard to anticipate all of the ways in which AI can work. We didn't anticipate all of the ways that electricity would change our lives. We didn't anticipate all of the ways that the internet would change our lives. It's unreasonable to think we can anticipate all of the ways that AI will change our lives. But it clearly is very powerful, enables a lot of computation to occur very quickly, and that means that computers will become a lot more powerful, and we can harness that to improve our living standards, to increase production, to do it more efficiently, and improve living standards.
Hey, Chuck, it seems like we've been trying to talk ourselves into a recession for about the last 2 years or so. I was glad to hear that in your commentary earlier tonight that you didn't necessarily have it on your radar. But whenever we hear this discussion about recession, one of the terms that I hear all the time is soft landing. We're maybe going to have a soft landing. Could you kind of explain to our viewers exactly what a soft landing would be?
Sure. So a real recession would be where we have job losses. The unemployment rate goes up, fewer people are employed, and you get a more precipitous decline in economic activity. Now, the economy has some natural growth in it. We have a growing population, and we have improving productivity. And the population growth is worth about 0.5% per year. Productivity is worth about 1% per year. And so there's a sort of natural 1.5% of growth per year. If the economy grows less than that, but grows, the unemployment rate would go up. Because let's say the economy is growing at 1. You'll get 1% from productivity, in which case you don't need to net hire anybody. Hiring could be 0. And if hiring is 0 net, then the normal growth in the labor force is going to spill over into unemployment. And that would qualify as a soft landing. It means you're not getting a downturn in the economy, but you're getting less growth than the underlying trend. And that's kind of what the Fed is trying to accomplish. It doesn't want to push the economy into recession. One of the big problems with creating a recession in order to bring inflation down is every politician will scream bloody murder at you. They'll blame you for causing a recession. And the last thing the Fed wants is to become the focus of politicians prior to an election. So the Fed would much rather try to engineer a very gradual deceleration in economic growth to gradually allow unemployment to increase without pushing it up. And that's why you'll never hear the Fed say they want a higher unemployment rate. They speak in circles and they speak in euphemisms. They would like to see more slack in the labor market. Let me translate that for you. More slack means more unemployment. They'll never say more unemployment, but they will say more slack. And they're communicating to the market what they're trying to accomplish. We understand what they're trying to accomplish. I guess most politicians are too stupid to read between the lines. But clearly, the Fed needs to do something to moderate economic growth. And that's what they're trying to do.
Do we have time for one more, or are we
Sure.
done?
Yeah, how about we all go for one more? Sure, I'll start with you.
All right, I'll start now. So Chuck, we talked about the Treasury versus the S&P 500. Folks that have been sitting on the sideline because of the fear of that recession that we haven't seen happen, and we just touched on that again. Is this the right time, and what type of portfolio should those folks be looking at?
You would have to end with that kind of a question. Look, it's a tough game to guess what the stock market is going to do tomorrow, next week, next month. You're never going to buy at the bottom. You're never going to sell at the top. If you do, it's purely by luck or accident. You have to look at where you are and make a judgment. Does it represent value? And if you're longer term oriented, if you're not trading oriented, you're not trying to buy today to sell tomorrow at a higher price, then if you pay a little bit too much or you manage to buy it for a little bit less, it's really not that material in that longer term context. So when I look at the market today, and I look not only at the market in general terms, I look at specific companies. I don't have any difficulty finding lots of individual companies at current prices that I'm comfortable buying. Now, if I buy it today and it goes down tomorrow, okay, I didn't buy at the bottom. I don't expect to buy at the bottom. And I do have a longer term focus, and I'm of the view that I've bought into a company that I want to own, I want to be a partner of, and longer term, I expect that to pay off. And sometimes if my timing is off, it means that I have to wait a little while for that to pay off. But I think it's important for investors to be invested in the market. Being out of the market on average is very damaging to long-term wealth. This is really one of those examples where you got to play to be paid, to make the money. You hear it about the lottery where you got to play to win, except that most people don't win. Only a very small number of people win. The lottery is what's called a net loss, not a net zero. It's a net loss game. The house wins, and on average, all the players lose. one player makes a lot and everybody else loses however much they bet. In the stock market, it's a net positive sum because the economy grows over time, companies become more profitable, and their shares become worth more. That's why when you look at long histories of stock prices, invariably, it's a very good place to be. And so I encourage people to invest, and to invest when they're young, and to invest all the time. Nick,
Alex, go ahead.
I think we're back to you.
Yeah, excellent. Alex, do you have one more question? Alex and Todd, and we'll wrap it up.
I'll keep it nice and short. Give us your favorite investing quote, Dr. Lieberman.
There's so many good ones.
Put you on the spot. I'm sorry.
I like one of the Warren Buffett quotes. Be greedy when everyone is fearful, and be fearful when everyone is greedy. Right? When the market is doing really well and it's going up and everybody's jumping in, that's actually a good time to think about taking money off the table. And when everyone is scared to death, when the market gets crushed, and it always happens, that's actually a time to go in. Think about what was going on during the pandemic. People were scared, understandably so, and yet it was shocking how quickly both the economy and the markets rebounded. The Fed was actually handled that situation relatively well, very well, and pumped money in. The economy and the markets both turned around. But that's really typical of most downdrafts of that sort. So when the market gets hammered, and invariably that'll happen again, it's actually a great time to buy.
I just wanted to thank you for talking about long-term investing, because I think doing this for 20-something years, it seems like the clients that get themselves in the most trouble are the clients that are concerned about how they did over the last month or the last 6 months, or how they're going to do over the next 6 months. And they look at those short-term periods, and we just don't know what the market's going to do over short term. And if you're focused on that, you're setting yourself up, I think, for a fall.
Absolutely. I couldn't agree more, Todd. In fact, I think we do a disservice to our clients by showing them performance over the last 6 months or the last year or last 2 years, 3 years. We contribute to thinking shorter term, and we should be encouraging them to think longer term. So, in the short run, performance is very, very random. People accidentally step into something that goes through the roof, and then other times they step into something that's a pit hole. One of the stocks that we owned recently was a company that everyone's probably heard of, Sirius Satellite Radio. And I bought it a year or two ago. I thought it had more potential than it did. It wasn't doing particularly well. And then all of a sudden, it was caught up in that meme euphoria, and the stock literally doubled in 1 day. 1 day. Thank you very much. I made a mistake. You've given me an opportunity to get out. Bang, I was out. So the stock went from 3.5 to 7. We sold all of our shares at 7. And I think today the stock is back to 3.5.
Chuck, that's a great note to end on. And we sincerely, Dr. Lieberman, appreciate your time, your insights, and our partnership with you and ACM. Alex, Cheryl, and Todd, thank you for being part of the panel with the great questions. And to our viewers, thank you so much for joining us, spending your Thursday with us. Go Lions. Remember, October is identity theft and elder abuse. November is housing market challenges and outlook. Thank you again to everyone.
Thanks,
Have a
Charlie.
great evening.
Thank
Hey
you.
guys.